The order didn't move markets at first. Traders kept buying, yields barely twitched, and headlines treated it like another routine Treasury report. But inside that document was a demand China has learned to read as a warning: adjust your currency, or Washington will do it for you. Hours later, Treasury auctions softened, the dollar slipped again, and the bond market started behaving like it was being priced without a buyer of last resort. Nothing broke. That was the problem. The system was still functioning, just not confidently, and when a market stops trusting the floor beneath it, it doesn't fall right away. It shifts its weight first. The report follows a rulebook most Americans never see, but that foreign finance ministries know by heart. The Treasury monitors countries that run a bilateral trade surplus with the United States of at least $15 billion, maintain a current account surplus above 3% of GDP, and intervene heavily in foreign exchange markets. Hit enough of those thresholds, and Washington reserves the right to apply one of its most aggressive economic labels: currency manipulator. That label isn't theoretical. In August 2019, during Donald Trump's first term, the Treasury officially designated China a currency manipulator, triggering volatility across global markets. The move escalated the trade war and signaled that currency policy itself had become a frontline weapon. The designation was later removed, but the precedent stuck. According to the Wall Street Journal, the label opens the door to IMF pressure, trade retaliation, and financial sanctions, levers few countries can ignore. This time, the pressure is being driven by Treasury Secretary Scott Bessent. For nearly a year, Bessent has sharpened his attacks on China's currency practices, arguing that Beijing's surplus and intervention policies distort global trade. In April 2025, at meetings tied to the International Monetary Fund, Bessent publicly demanded tougher scrutiny of surplus economies. Bloomberg reported that he accused the IMF of failing to confront countries most in need of critique, singling out China by name. Bessent's argument wasn't subtle. He said the IMF must call out countries that pursue opaque currency practices and unsustainable lending, framing the issue as a defense of global stability. But the subtext was unmistakable. Washington needs control over the dollar's direction at a moment when that control is slipping. The immediate question is why the Treasury is confronting China now, when the trade war is already entrenched. The answer lies in the data. U.S. exports are falling, and the strategy meant to revive them is backfiring. According to Commerce Department figures cited by Reuters, U.S. exports of goods and services fell 3.6% in November, while imports rose more than 5%. In a single month, the trade deficit nearly doubled. That reversal stunned policymakers who expected tariffs to force domestic substitution. Instead, consumers kept buying imported goods because they remained cheaper. Manufacturers kept sourcing overseas inputs because domestic alternatives were more expensive. And exporters found themselves priced out of global markets as costs surged across supply chains. The tariff structure explains why. Financial Times analysis shows the U.S. effective tariff rate on all imports hovering around 17%, levels not seen in generations. On Chinese goods, the average tariff exceeds 40%. Many of those goods are intermediate inputs used by American producers. When input costs rise, final export prices rise with them. The result is predictable. U.S. exports become less competitive. This is why Washington's focus is shifting from tariffs to currency. Raising tariffs on China further is politically and strategically risky, especially given Beijing's control over rare earth supplies. Currency pressure looks cleaner. If China allows the renminbi to strengthen, Chinese exports become more expensive globally. In theory, U.S. exporters regain market share, but theory collides with reality. Even if China's currency appreciates by several percentage points, the gap created by U.S. tariffs is far larger. American producers are still absorbing tariff costs embedded throughout their supply chains. A stronger renminbi can't undo that damage. There's a deeper irony. China doesn't need Washington's demands to strengthen its currency. Over the past 12 months, the renminbi has already appreciated roughly 3.4% against the dollar. During that same period, China's trade surplus reached record highs. Global buyers kept purchasing Chinese goods, even as the currency strengthened, because alternatives were more expensive. Beijing's motivation is structural, not reactive. President Xi Jinping has openly called for the renminbi to gain greater global reserve status. Not to replace the dollar outright, that would require decades of institutional change, but to attract long-term capital into Chinese bond and equity markets. Currency stability is essential to that goal. Strengthening the renminbi supports financial credibility and encourages foreign investment. This helps explain another trend unsettling Washington. Money is drifting out of U.S. debt. The dollar has weakened for over a year, and foreign appetite for treasuries has softened. IMF reserve data released recently shows gradual diversification by central banks, trimming dollar exposure at the margin. It's not a collapse, but it's a signal. While Washington pressures Beijing, the U.S. fiscal machine is accelerating. Treasury issuance is surging to fund deficits that remain stubbornly high. In the past year alone, U.S. importers have paid more than $260 billion in tariffs to the Trump administration, roughly 3 times the level seen in 2024. That money didn't strengthen competitiveness. It raised costs and drained liquidity from producers. Manufacturers are now squeezed from every direction. Input prices are higher. Export demand is weaker. Interest rates are not falling fast enough to offset either. The strategy meant to reshore production has instead inflated the cost base of the very industries it aimed to protect. This strain collided with a new source of fear: the Federal Reserve's balance sheet. Markets had been operating under 2 assumptions. First, that President Trump would push for lower interest rates, weakening the dollar and boosting asset prices. Second, that the Fed would continue buying U.S. bonds to cap yields. At the last FOMC meeting, Jerome Powell committed to roughly $40 billion per month in bond purchases. Then Kevin Warsh re-entered the conversation. Warsh, a former Federal Reserve governor, has been floated as a potential future Fed chair. His views are well known and deeply unsettling to markets. Warsh has repeatedly criticized quantitative easing, arguing that asset purchases fueled inflation and worsened inequality. In public remarks, he described inflation as the most regressive tax a government can impose, and warned that an oversized Fed balance sheet invites instability. The reaction was immediate. Equity markets fell. Bitcoin collapsed. Gold and silver sold off sharply, with gold losing more than $1,000 in just 3 days. The S&P 500 dropped around 1.3%. Investors weren't reacting to policy changes. None had happened yet. They were reacting to the possibility that the Fed's safety net might disappear. Behind the currency fight, another pressure point is tightening foreign participation in U.S. Treasury auctions. Reuters reported in recent days that indirect bidders, often a proxy for overseas central banks, have been absorbing a smaller share of new issuance, even as auction sizes climb. That shift is subtle, but it forces domestic buyers to step in at higher yields, exactly as Scott Bessent accelerates borrowing to cover widening deficits. Donald Trump's trade posture has compounded that strain. Public threats of expanded tariffs and sanctions have increased hedging demand against the dollar, while simultaneously discouraging long-duration Treasury exposure. Financial Times analysis shows volatility premiums embedded into U.S. yields rising even without a formal credit event, reflecting political rather than economic risk. Jerome Powell is now operating in a narrowing corridor. The Federal Reserve's commitment to ongoing bond purchases is cushioning yields, but Bloomberg notes internal debate is intensifying as inflation expectations remain elevated. Powell's room to maneuver shrinks further if Kevin Warsh's critique gains institutional traction. Warsh has argued that persistent balance sheet expansion distorts price discovery and traps the Fed into perpetual market rescue. Xi Jinping, by contrast, faces a different constraint set. China's bond market remains tightly managed, capital controls limit speculative outflows, and currency appreciation can be paced without destabilizing domestic credit. IMF surveillance data shows China's external balances improving even as the renminbi strengthens, undermining Washington's claim that appreciation would materially shift trade flows. The asymmetry is the story. The United States must finance deficits in open markets, persuade foreign buyers, and stabilize risk assets simultaneously. China can sequence adjustments. That difference, not tariff rates or currency slogans, is what markets are quietly responding to as yields drift higher and confidence thins. The fear is mechanical. The Federal Reserve still holds roughly $6.6 trillion in treasuries and mortgage-backed securities. When the Fed buys bonds, it creates money and injects liquidity into the system. When it sells, the reverse happens. Liquidity is withdrawn. Money supply contracts. Banks feel the strain first. Markets follow. If Warsh were to push aggressive balance sheet reduction while Treasury Secretary Bessent ramps up debt issuance, the bond market would face a supply shock. More bonds, less demand. Yields rise. The 10-year Treasury has already been rebounding since December, driven by a weaker dollar and foreign selling. A move back toward 4.5% yields would tighten financial conditions across the economy. Higher yields don't stay contained. Corporate borrowing costs rise. Housing slows. Equity valuations compress. Other central banks hesitate to cut rates, fearing capital flight. A U.S. bond shock transmits globally because the dollar system sits at the center of global finance. This is the contradiction now visible. Washington wants a weaker dollar to support exports and asset prices, but it also needs global investors to absorb record Treasury issuance. It wants tariffs to protect industry, but those tariffs inflate costs and crush competitiveness. It demands China strengthen its currency, even as Beijing does so for its own strategic reasons, and continues exporting at scale. If the Fed drains liquidity while deficits expand, the system tightens fast. If the Fed reverses course and resumes easing, the dollar weakens further and confidence erodes. Either path carries risk. Markets are no longer debating outcomes, they're pricing instability itself. China understands this landscape, strengthening the renminbi while maintaining export dominance signals confidence in its internal balance. The United States, by contrast, is leaning on external pressure to manage internal contradictions. Ordering China to obey U.S. currency rules won't reverse falling exports. It won't undo tariff-driven inflation. And it won't stabilize a bond market facing historic supply. What it does reveal is how little room remains. The stress isn't coming from Beijing, it's coming from the arithmetic beneath Washington's own system and the growing realization that the backstops everyone relied on may not be permanent.